The RBI has proposed a new framework for how banks, NBFCs, and other regulated lenders set interest rate on loans. The rules are not final yet, but if implemented, they could change how loan rates are calculated, disclosed, and revised. The aim is to make lending more transparent and strengthen protections for borrowers. So, what exactly is the RBI proposing? First, there would be an important distinction between banks and other lenders. Commercial banks would continue to link floating rate retail and MSME loans to an external benchmark. A floating rate loan is one where the interest rate can rise or fall depending on changes in the benchmark. But NBFCs, All India Financial Institutions, regional rural banks, and cooperative banks would have more flexibility. For these lenders, linking floating rate loans to an external benchmark would not be mandatory. Loans covered by the migration requirement would have to move to the new framework by 1st of April 2029. But there are protections for borrowers. The migration cannot increase the interest rate applicable at the time of the switch, and lenders cannot charge borrowers a fee for moving their loan to the new framework. The RBI is also proposing additional safeguards for small borrowers. For loans up to 50,000 rupees, lenders would have to ensure that interest rates and other charges are not excessive. For microfinance and other specified small value loans, lenders would also have to set a ceiling on the annual percentage rate or APR. APR reflects the broader annual cost of borrowing, including applicable interest and charges. For short-term agricultural loans, the total interest and other charges cannot exceed the original principal amount. So how would lenders calculate your interest rate? Under the proposed framework, rates could be based on an internal or external benchmark plus a risk-based spread. The benchmark reflects broader interest rate conditions. The spread can reflect factors such as the borrower's credit risk, the lender's operating costs, and other applicable premiums. For floating rate loans, lenders would have to clearly disclose the benchmark, when the interest rate will reset, and how frequently that reset will happen. They would also have to follow a board-approved policy for determining the spread with restrictions on how frequently it can be changed. There is another protection for borrowers. If the benchmark used to calculate a floating interest rate is discontinued, the lender would have to replace it without putting the borrower at a disadvantage. For borrowers, the biggest change would be greater visibility into how a loan rate is calculated, what they are paying, and when that rate can change. Small borrowers would get additional safeguards, while lenders would face clearer rules around pricing and disclosures. But these are still proposed rules. The final framework could change before it is implemented. Follow Business Standard for more such stories.